Welcome to Nordic Wealth. If you're serious about growing your money, building long-term wealth, and achieving financial freedom, you are definitely in the right place. Today in this explainer, we're totally dismantling a pretty dangerous illusion. It's this widely held idea that earning a massive salary automatically makes you wealthy. Honestly, it's a trap that millions of people fall into. So let's just dive right in, shall we? We're going to look at the actual nuts and bolts of true financial independence and see exactly how real wealth is built, kept, and grown over time. So start by asking yourself this. Why do high earners go broke? I know, it feels totally counterintuitive. You'd think making more money solves all your money problems, right? But the wealth management firm Skybound Wealth highlighted a really alarming reality. They actually work with folks making 6 or even 7 figures who are still somehow living paycheck to paycheck. The assumption is always that a big income fixes everything. But the truth, without a rock-solid strategy, a massive paycheck is often just a fast track to financial ruin. And this comparison brilliantly hits the nail on the head. It's the classic trap of living rich versus the reality of building wealth. When you're just living rich, you're pouring money into a lavish lifestyle, and you are 100% dependent on your active income. Think about it. If your paycheck magically disappeared tomorrow, how long could you actually survive? Building wealth, on the other hand, is a whole different ballgame. It's about accumulating assets. It's about setting things up so your money works for you independently. You're shifting your mindset from being just a consumer to actually being an owner. All right, let's move right into Section 1, the millionaire next door. Okay, so if a high salary isn't the secret sauce, what on earth is? Well, there was this massive 20-year study of over 1,000 real-world millionaires, and it gives us a really fascinating blueprint. As you can see, they efficiently allocate their resources, they prioritize their actual independence way over perceived status, and they often lean into emerging markets or self-employment. But you know what the most striking takeaway was for me? Over 80% of these millionaires are first generation, meaning they didn't inherit a dime. Their wealth comes from playing incredible defense. They live conservative lifestyles, consistently spend way less than they earn, and they invest the difference. They aren't trying to look wealthy, they are focused on being wealthy. So we know fiscal discipline is the absolute foundation. But what does that look like on a typical Tuesday? Let's ask a super relatable question. How much does a cup of coffee really cost you? The Securities and Exchange Commission, or the SEC, actually breaks down how incredibly vital small, everyday expenses are to your entire wealth-building journey. Just look at this number. According to the SEC's math, if you redirect just $1 single a day, which, let's be honest, used to be the cost of a basic cup of coffee, and you put that $365 a year into an investment account, earning a very modest 5% annual return, it doesn't just sit there. By the end of 30 years, that one daily dollar grows to over $1,500. This isn't some financial magic trick. It's literally just the mathematical power of compounding. Small, disciplined savings on a regular schedule absolutely snowball into big money over time. Which brings us perfectly to Section 2, the exponent of Thrime. We've talked a lot about frugality, but now we really need to look at the math. The engine driving this whole wealth-building machine is compound interest. Simply put, it's earning interest on your savings, and then earning more interest on that accumulated interest. And here's the crucial part. In the actual mathematical formula, the variable for time literally sits in the exponent. Adding more years compounds your money aggressively, while adding more cash only scales it in a straight line. Time is, without a doubt, your ultimate multiplier. To really cement this concept, let's look at this incredible case study from FinTool Suite. It blew my mind a little bit. We have 2 investors here, Amma and Ben. They're both contributing $200 a month and earning a 7% return. Now, Amma starts at age 25, invests for exactly 10 years, and then she stops completely. Never adds another dime. Her total out-of-pocket contribution is just $24,000. Ben, on the other hand, waits until he's 35 to start, which is the exact age Amma stopped. Ben diligently invests his $200 a month for 30 years straight, contributing a massive $72,000 out of pocket. But look at the final balance at age 65. Amma ends up with roughly $281,000, while Ben finishes with about $244,000. Think about that. Amma's 10-year head start completely crushes Ben's 30 years of hard effort, even though Ben invested 3 times as much of his own money. No way, right? But it's true. This right here is the structural edge of time. A gap in your investing during your 20s costs you exponentially more than that identical gap in your 50s. It is so tempting to wait to invest until your income rises and contributing feels a bit more comfortable. But waiting sacrifices the exact years the compounding formula values the absolute most. The earliest dollars you invest carry the most weight because they just have the longest runway to roll, gather momentum, and grow. Moving right along to section 3, saving versus investing. Now that we've got the math down, we have to actually execute. And listen, there is a massive difference between saving your money and investing it. And frankly, you need both, but for entirely different reasons. Saving is for highly accessible, very low-risk vehicles. It's absolutely perfect for an emergency fund if you suddenly face unemployment or a medical bill. The trade-off, it pays a super low wage on your money and is incredibly vulnerable to inflation eating away at it over time. Investing? Sure, it carries a higher risk of losing your principal in the short term, but over the long haul, it is the only way your money actually outpaces inflation to build real, lasting wealth. The SEC actually draws a very clear line in the sand with these products so you don't confuse them. Things like checking accounts and certificates of deposit, or CDs, belong firmly in the savings category. They keep your money safe. But to actually invest, you need to be looking at vehicles like stocks, mutual funds, and real estate. If you leave money that you realistically won't need for 35 years just sitting in a basic checking account, you are effectively destroying your purchasing power year after year. And that brings us to our final part, section 4, the boring strategy. So how do everyday people like you and me actually execute these investments without falling into those high-stress, high-risk gambling traps? I am absolutely obsessed with this quote from Evergreen Financial Group. They say, "Investing is a crock pot and trading is a microwave." I mean, trading might give you those quick short-term hits, but it is incredibly difficult to sustain over a lifetime. True wealth accumulation is a crock pot. It's slow, it's steady, and honestly, it's a little bit boring, but it works. A BlackRock study actually showed that almost 95% of people made money in any 10-year time period between 1970 and 2020. Evergreen breaks this down into a super straightforward action plan for beginners. Step 1, diversify properly and effectively. Basically, don't put all your eggs in one basket. Proper diversification means spreading your money across different asset types, stocks, bonds, maybe some real estate, not just buying 5 different tech stocks and calling it a day. Step 2, invest the exact same amount consistently. This is known as dollar cost averaging. By putting aside money regularly on autopilot, your discipline easily outweighs market performance, and you subconsciously train yourself to delay gratification. And finally, step 3, monitor your internal fees, also known as expense ratios. Using low-cost index mutual funds or ETFs stops these big investment companies from quietly eating away at your hard-earned compounding returns. So we've covered the whole shebang today. We've talked about the illusion of a wealthy lifestyle, the quiet discipline of everyday millionaires, the absolute mathematical magic of time, and the boring but highly effective strategies to actually execute your wealth building. It all comes down to taking action. So I'm going to leave you with one final provocative question to chew on. What will you do differently with your very next paycheck? Will you fund a lavish lifestyle that ultimately leaves you vulnerable? Or will you plug in your crockpot, let time do the heavy lifting, and secure your own financial independence? The choice is entirely yours. If you found this explainer valuable, make sure to subscribe to Nordic Wealth for more insights into investing and personal finance. See you in the next one.